In this monthly market update, we are picking up where we left off in October as cattle market chaos levels out and we catch up with HighGround's Curtis Bosma on the tail end of the CME and American Dairy Products Institute's Dairy Purchasing and Risk Management Seminar that has us wondering, will the Whey Boom outpace cheese production and will butter make a comeback anytime soon? All this and more today on the Uplevel Dairy Podcast. This podcast is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, and futures and options brokerage and advisory programs to a diverse range of dairy market participants throughout the supply chain. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of November 18th, 2025 at 2:30 p.m. Central Standard Time and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Well, Curtis, welcome back to the Uplevel Dairy Podcast. And you just got back from a dairy purchasing and risk management seminar back here in the Midwest last week, huh? You were out in Chicago last week, Curtis?
Yeah, spent a little time in Chicago, got to connect with a lot of our clients and stuff. Typically, that conference that CME ADPI puts on every fall has a lot more of a commercial kind of buy-side presence at it, but this year we actually had a couple of producers there as well. It's a good time, especially at a time like this where we're just coming out of the government shutdown. There's minimal fundamental data to point out. Being able to sit down, have those conversations with our clients and people in the network. It was really great to get caught up and really follow all these kind of trends that are happening in these markets.
So you just got done, Curtis, you're hanging out with the CME folks and those involved in dairy processing. Any key takeaways from that meeting, just from hanging out with others in that side of the business?
Yeah, so not necessarily market sentiment related, but just looking at the overall growth and development. I know, as we've probably talked about before, the CME dairy futures contracts are relatively new compared to a lot of the other products that trade at the CME. The grains and livestock markets have a 100-plus-year-old rich history of how the price discovery and risk transfer process occurs. But dairy's really only been around for around 30 years or so, which means that we're still developing a lot of that liquidity, but we've seen good growth in these markets. And it was great timing for a conference because we just came out of 2 months where we had, I think it was September and October, we had record volume and open interest in CME dairy futures and options. So overall, I think that's good for the market in terms of growth of liquidity because that makes it so that all the tools we talk about, whether it's futures, options, insurance programs, all those things, they're based on a futures market. So the more volume we have there, the more liquidity we have there, the better it is for all market participants in general.
And speaking of what's been going on the last few months, it's been a bit of a struggle because for the longest time, you didn't have the numbers that you needed from USDA to work with. And so what's changed for you in the last couple of days here, last week, with what you now have at your fingertips for information from USDA?
Yeah, so with the government shutdown, we didn't get any reports from USDA to confirm anything that's been going on. It was particularly challenging because the next report or key report we were waiting for was the September 2025 USDA milk production report, which for anybody that had DRP coverage on for the third quarter of 2025, you needed that last report to publish all of the yields so that we could actually settle out the coverage. I think that was a big driving reason why USDA was able to get some special funding to open NAS for at least publishing that report prior to the shutdown, kind of concluding there. So they got that report out, and it was maybe not the most friendly report to the dairy markets, but it was nice to see some data there. But we had milk production up 4% year over year in the U.S., huge growth out of states like Idaho, Texas, New York, California back into kind of growth mode versus prior year. We're going to start to see some of the weird numbers the next 2-3 months on California because if you recall, like it was exactly a year ago, we got hit with bird flu so bad. So don't be surprised if you see California up 12 or 13% year over year in one of these upcoming reports. It does not mean there's been any robust expansion. It's just a bad comparative number. The growth is on. We're seeing a lot of that across the entire U.S. right now. It seems like the majority of milk sheds, with the potential exception of a few, have been in strong growth mode. As we recall, 2024 margins were very good. So people have been really kind of foot on the gas and pushing milk production and growth mode as much as they can. With that milk production report, we were able to settle out those Q3 DRP claims, which for most states was based on that yield adjustment. Really didn't draw any blood. A lot of our clients in upper Midwest, Pacific Northwest, other regions like that, got some nice payouts for coverage they had on there because, in a lot of cases, Class 3 and Class 4 futures spent a large amount of their time trading above where the third quarter settled. But we did see, so for California and some of the other regions that have had strong milk per cow yield growth, that has been kind of negative to the way that the DRP program settles out. So frustrating to see that for some producers. But if we recall back to people that had coverage on for the fourth quarter of last year, with bird flu, we had big swings the opposite direction too. So we can only hope that over the longer average that yield adjustments kind of don't really have that much of a net effect. But a situation like this, I understand, we've had some people that have gotten bummed out and frustrated that it moves so much at this kind of critical time in the markets.
Curtis, a month ago when we sat down and recorded the market report from October, the headline was chaos in the cattle markets. How much of that has changed?
It's still chaotic. Nothing has really changed. It seems like ever since we saw some of those initial tweets or Truth Social posts, whatever you want to call them, from President Trump, it really turned up the dial in terms of the political risk that we're seeing in the cattle markets. January feeder cattle topped out at around 380 100 weight. We're trading now closer to that 330 range. So we've come down a little bit, but we've stabilized to a certain extent there. There's been, again, limited fundamental data, so not much to point at other than auction prices. And from a cash market perspective, feeder cattle seem to still be holding on to a good amount of their strength. But there is starting to be a little bit of weakness there. So again, it's about that time where we could be in a position where we're catching up in the cattle market cycle. Margins have been favorable enough for long enough to where that would make sense for that to start coming together and rebalancing against where current demand's at. But there's still a lot of large cattle processors and producers that are looking at this and saying, hey, I don't think there's quite as many cattle as people think out there. I think this market's just very prone to headlines right now. When you get to extreme highs or lows of any commodity market, you start to see a lot of this whipsaw effect where a lot of this tension gets built up of, hey, we're at these record high prices. Everybody wants to be the one to sell the highest price. So I think we're going to continue to see more volatility. But the other kind of, I would say, kind of comical thing is when you look at prices, and we had a period of time there where cattle futures were limit down 3 out of 4 days in a row. And everyone's going, oh my gosh, here we go, this thing's falling apart. And even with a dramatic move like that, prices were only at their lowest level seen since August. It wasn't that long ago because we've been on such a strong move to the upside that if you just zoom out a little bit, look at where prices are, they're still sitting at a very, very good level. So again, that's where with a lot of clients we're talking to, both on the dairy and the cattle side of our business, we're making sure people zoom out and think over the long term. Like when you get to the end of 2025 or you get halfway through 2026 and you're running your numbers and you're putting together your financial statements, do the prices you see now still make sense to your budget? Do they still produce that positive outcome? And in a lot of cases for dairies, particularly ones that have good positions on the milk side already, we're looking at this and saying, yeah, this does still produce a good outcome. So it is still good value to secure if it has not been covered yet. We've also had a number of people, I feel like with this, we can kind of pivot over a little bit on the milk side, but Class 3 and Class 4 futures, particularly Class 4, has taken a bit of a beating over the last 2-3 months here. We're down at some low price levels. We're seeing some of the futures contracts trade, below $14 a hundredweight. And with that, I think people are looking ahead and saying, hey, if the milk revenue that my dairy generates isn't going to be that spectacular, what other revenue sources are kind of keeping me in positive territory when it comes to cash flows? And beef is the answer. It's still at a good price level to where we're still producing roughly about $4 a hundredweight on a milk basis for an average dairy. We have a model that assumes kind of I think it's about a 28% cull rate. And then for every 1,000 milk cows, it's about 50 head per month of beef calves that are available. Of course, everyone's operation is going to be a little bit different, but that gives us at least kind of an average guiding light so that we can track, okay, what is this worth on a revenue perspective? And yeah, the math still checks out to about $4 a hundredweight on that stuff. So with that amount of revenue being able to come out on that side, I mean, historically, that's been something that hasn't really been that significant until just a year or two ago. That has still been an area where we've been encouraging people to kind of take action and get coverage there.
So that's kind of a peek into what you've seen in the cattle markets. And I think one of the big things that I'm taking away from the conversation is to just use some caution with the headlines and not to get wrapped up in the volatility of what the news might say or what might be going on in media, but really to make some rational decisions based on what's best for your business, especially as we get towards the end of the year here and look ahead. And as we move out of the conversation of cattle markets and more into what's been going on in dairy markets, what are some of the headlines that you've seen in the last few weeks?
Headlines we're seeing in dairy, a lot of the chatter lately has been with the release of the September milk production report. It was just been, oh my goodness, we have so much milk. It's all coming at us. And I think it is a little bit concerning of what could be for the next couple months here in terms of the pressure that's on this market. But not everything's in that bad a shape. There's a few bright spots to look at, and I try to be the eternal optimist as much as I can. And one thing coming out of the conference last week from the CME ADPI, the amount of new product development and focus on the higher protein whey derivatives is quite amazing to see, what everyone's going after there. It's something that shouldn't really be a surprise to anybody when you go to the grocery store, how every, cracker or snack or anything, the largest text you see on everything is how many grams of protein does this have in it. And in a lot of cases, the protein is sourced from some sort of a whey protein isolate, whey protein concentrate that's going into the ingredients of whatever product you're looking at. And as a result, we've seen, the last couple months, whey protein prices have started to kind of climb up a little bit. You could make the justification, a lot of this new investment in cheese processing capacity was to get to that whey stream. From what we're hearing from a lot of those newer plants and newer production lines, they still haven't quite gotten to the point where they're processing or producing those higher value whey products yet. But the demand for those products seems to be somewhat insatiable. You're hearing, depending on the variety of whey derivative you're talking about, it's, in that $9, $10, $11 a pound for some of these powders that are coming off of those things. So it's pretty amazing what value is able to be created in that stream. And as a result, the commodity, dry whey prices have been on an upward trend. We're sitting right around 70, 75 cents on and moving up from there. That's been something when you look at class 3, class 4 pricing, it's been keeping the class 3 price somewhat buoyant relative to the rest of the market, because every time whey moves up, that's somewhat supportive to that class 3 pricing formula. And it's even potentially, minimally more beneficial to the class 3 formula, because we're moving into next month is December, which will be the final adjustment based on the ruling to the federal milk marketing orders, where we're going to be updating the skim components that are in there. So they're leaving the fat components in class 3 and class 4 milk at 3.5% butter fat. So that stays unchanged, but they're raising the skim component factors to a slightly higher level, which, in terms of a producer's milk check, actually doesn't really make a difference, because you're paid off of your individual components that you produce in most cases. But in terms of how futures and options will trade and how the settlement procedure for everything will be, it has a little bit of a difference of how that's going to be. And then kind of on the same thing for, class 3 and cheese, kind of saying that all of this new processing capacity trying to chase after this whey stream is a positive thing. The scary side of that is with whey comes cheese. You can't have one without the other. And it used to be historically that whey was the byproduct of cheese making that was kind of the throwaway thing. And now it's become cheese is a little bit of the byproduct of that process. So since we are in a market that prices primarily off of commodity style cheddar cheese, if we do produce enough of it and it outpaces the demand that we have for it, it will result in lower prices. And it seemed to be the general consensus that even with the lack of fundamental data, talking with market participants throughout the supply chain, that we are going to see cheese prices soften going through the first quarter, maybe even second quarter of next year. Now, I don't think it's going to get drastic. Seeing a $13 class 3 price seems pretty unlikely given at least the current momentum and indication of what we're seeing from a supply and demand perspective, but it still is, you're going to have downward pressure on it. So I think for our job as risk management advisors to dairy producers is just setting those expectations of saying, hey, this could be a problem. We want to make sure that if it is a problem, that we don't get caught on the wrong side of it. And then if we shift over to more of the class 4 side of things, the butter market has been on a little bit of a struggle. We've made some pretty historic lows back to almost 4 or 5 years ago now of where we're having to look back on the calendar to find a period of time where prices were this low. Getting below 150 in the spot market is definitely not a good thing for that market at all. But we're starting to see a little bit of pushback there. I think when prices get this low, you're either seeing export business pick up in a significant way because we're so competitive from a price perspective, or you're seeing a lot of end users that are just looking at it and saying, hey, we're going to stockpile this because it's such a good deal and we'll stay ahead of it a little bit and we'll pick up some of our 2026 needs ahead of time and store it somewhere. So that could be something to be mindful of, because as we work our way into next year, if there is not as much demand on a consistent basis, that could continue to spell some trouble there. It'll also be very interesting to watch to see what happens with milk composition over the next 6 to 12 months, because when butter prices were high, we had 260, 270 butter prices, and feed is cheap. Go ahead, let's feed as much palm fat as we can. Let's crossbreed everything to Jersey. Let's really push on these milk components. And at a certain point, that's not really going to make as much sense to push for that as aggressively on that with low butterfat prices. So be monitoring that pretty closely. On the other side of the class 4 equation, non-fat dry milk, actually catching a bit of support there. We've kind of been able to continue to push up to some of the highest prices we've seen here in a little bit. I think in that market, it's kind of been the least exciting one among all markets the last couple months here. But what we continue to point at with that market is, protein is protein. So I think a lot of people, with the whey protein derivative stream that seems to be super attractive, everybody wanted to work that into every product. There's still a historically, good relationship between non-fat dry milk and dry whey, because those two products are essentially powdered milk proteins. They have a much different composition, and I know that's probably a gross oversimplification from a food science perspective, but it still is protein, and if the prices on that get low enough, we are able to move that product quite easily. And that's, of the core 4 dairy commodities, probably the easiest ones to plug and play around the world, since there's almost an international standard for what we can trade.
One question that I have for you, especially coming off of the meeting you were at last week with CME and ADPI, is the plant capacity in the right spot to handle the demand for whey protein?
That's a good question. I don't feel like we've seen the market cycle for whey, particularly if we're talking these higher protein whey derivatives, really meet its full point of maturity yet. Looking at the number of products, and I know there was a presentation on this last week, but the number of products that get developed in a market, like that are tested by new brands or anything like that, and they compared how much we see historically for butter and cheese and what's getting a lot of product development. The whey product development pipeline is far more robust because it's easy to work into just about anything. I mean, we've seen it from crackers to snacks to even the clear protein trend, where you could buy like the flavored juices that have a whey protein isolate in it as well. It's amazing what they can mix that stuff into. I don't think we've reached a point yet where we can answer that question accurately to know, hey, have we really met the right price point here or the right production kind of capacity? I do think, though, you got to tip your hat to the dairy industry. Like you said, if you zoom out on the timeline and say, hey, wasn't that long ago that people were land spreading whey or trying to get rid of it, and now we've developed ways scientifically to add value to milk. So I think it's a positive sign as an industry that, our product is very, like, raw milk as a product is very, like, malleable into all kinds of different things. And it's awesome to be in a spot where we can flex that product to find value where maybe we didn't know it was there before.
The opportunities are endless. And like you said, just walk through the aisle in the grocery store and you'll see things that are tolling their protein content that never would have been protein sources before. But hey, thanks to whey protein and all of the developments that led to that value add for the dairy industry. And also, speaking of conversations that have changed, you brought this up too, Curtis, and that's really this conversation around components. So again, I'm curious what you picked up last week in your meeting with processors and Chicago Mercantile. In the area where I'm at here, we're looking at some deductions around oversupply of components, especially fat. So can you shine a little light on that? What did you hear last week about what that looks like in the months ahead and in the year ahead for what might be overproduction of components?
Yeah, it's definitely something that people were talking about a little bit. And it's not, I wouldn't say the newest thing, but like if you take a look, for example, at like base programs that a lot of cooperatives or milk handlers use for kind of a lever to pull for supply management purposes. Historically, a lot of those base programs were simply just based off of a gross pounds of milk and say, hey, you're allocated X pounds of milk to produce a month or per day or whatever the metric was. And they say, okay, don't go over that or the penalty is this. And that was kind of the guiding light. But then people kind of figured out like, hey, you're not paying me for the pounds of milk. You're paying me for the individual components. So how about we just highly concentrate that milk down to the components you're going to pay me for by changing our feeding and breeding strategies, which you give a dairy farmer a financial incentive to do something, they're going to do it, and they're going to do it very well. It's been proven time and time again that that's going to be the case. So that was something that I think now a lot of these processors, and some have already shifted to this, but rather than just having a base program set on gross pounds of milk, of either setting it on total pounds of a certain component or a ratio of components that's optimal to whatever product they're making on the tail end. Because if you're making cheese, you kind of need butter, fat, and protein to be at kind of like an 80% ratio. And if you end up with too much butter fat, if you've got a Jersey herd that's at a 5.2 butter fat and a 3.0 protein, well, you're going to have a lot of extra butter fat that you can't make cheese with. And as a processor, that's not really a winning endeavor because now you have extra cream that you have to dump in the marketplace somewhere.
So this is like an ongoing puzzle of figuring out what that right balance looks like between the milk coming in and the demand from the consumer and the ability of the processor to be able to make the most sense out of both sides of that. So what do you think is coming up in the future?
I don't think the trend is going to change. I think particularly if you look at like the rise of the Holstein dairy cow of, many years ago it was Jerseys were the ones you can get the components out of, and Holsteins were the big ones that had the flow. And now Holsteins have kind of caught up in a lot of ways in terms of milk composition. And I don't think that's going to change anytime soon. I think there's been a lot of advances in genetics and a lot of science poured into that. And it's still chasing after components. I'm not saying it's a bad thing. I'm just saying like the last little incremental push, whether that be from feeding a byproduct or a bypass fat or something like that, that's going to push us over the edge, that may financially make less sense in this stage of a market cycle. But I would say overall, I mean, the amount of growth and what you can get in terms of milk per cow or even just milk composition on these herds, like that trend is not stopping anytime soon.
Well, let's shift over to looking at some of those other commodity markets. And what have we seen in soybeans and corn and other of those major commodities that we like to pay attention to on the dairy side?
Yeah, so on the feed side of things, the corn market has moved up a little bit. We've still been having a good year in terms of exports there. We got an updated WASI report with, again, a slightly reduced corn yield, but still coming in at a very, very large crop. I think we're probably in a position now where corn has likely set its low, at least for a while. When we had that big number over the summer in Q3, when we had a 188 bushel per acre yield thrown out there, that really put the pressure on corn futures and took us to contract lows. But as we're getting through harvest and getting into the season we're in now, that yield number has been walked back a good amount. And we're also seeing a little bit of like spillover demand from the soybean side of things, where soybeans were kind of plagued throughout this entire growing season with, hey, we're in this trade war. We lost our biggest customer in China that's not going to buy anything this year from the US. So prices were down in the dumps for that market for quite some time. But now we're getting back to a point where, okay, hey, we're going to have a trade deal with China. Things are coming together. But I will say the soybean market has rallied quite a lot over the last couple of weeks on this news of a trade deal. But China still hasn't purchased anything yet. And we still have a pretty big crop coming out of the field. So there is maybe this a little bit of speculator-driven rally of markets moving up a little bit. I'm not wishing it to go lower for the soybean farmer because they've had a rough go the last couple of months, but I would be a bit more cautious about that market because we're in a situation where, like markets have moved pretty significantly based off of a headline. But the reality of the situation is China has bought a lot of what they need from South America, specifically Argentina already. And Argentinian and Brazilian production for both corn and soybeans have been moving up to the point where they can satisfy that Chinese demand. And so other than kind of the posturing of these trade agreements, there's really no logistical reason that China would need to buy from the US anytime soon. So a lot of that may just be us putting the cart before the horse on that rally of saying, hey, our biggest customer's back in town, but they don't really need anything quite yet.
And what else have you seen going on? Any other major movements in the marketplace?
I mean, with limited data, there really hasn't been much to point at, but I will say from a margin management perspective, I would say this year has been a good one. I mean, kind of nice to see for the proactive people that have been staying in markets and staying hedged well ahead of time. Back in June, July, August, locked up a lot of positions going into 2026. Everybody that's got good DRP, LGM positions on now, and even LRP is sitting well ahead on these markets. But when you look at participation data, I know we pulled up some reports here recently just looking at how much of the total amount of milk in the US is actually covered by these programs, because we know the people that we talk to, how they're positioned and how they're feeling about things, but how is everybody else doing? Because I don't have all the time in the world to talk to every dairy producer as much as I wish that I could, but the participation for 2026 is actually quite low. We're in kind of around 17 to 20% of overall U.S. milk supply based on kind of the growth trajectory of where we project milk production to be for the first 2 quarters of 2026. And that's been as high as 35, 40% in other quarters where there's been good opportunities to lock up margins. And it's kind of a little bit helps you gauge kind of how the overall industry is doing. And it is a little concerning that there's a lot of uncovered milk out there going into this next year. And a lot of those opportunities have kind of moved away a little bit. So kind of encouraging people, like if you feel like you're maybe not in the best position for how you've got your marketing plan structured, how you've put together things for this next calendar year, there still are some opportunities on the table. They may not be as good as they once were, but this is where it helps to know your numbers and make sure that we're staying out in front of this thing. We definitely don't want to get in a situation where we're playing defense, and it is something that we tend to see time and time again. I mean, I've been doing this for well over 10 plus years now, been in the industry my whole life, but been following markets with a eagle eye for over 10 years. And whenever we see extreme volatility and we see margins get crushed like this, we really tend to see a lot of people come our way looking for a silver bullet or an answer of how do we solve this. And it is kind of a bummer. I know we've talked about this before, Peggy. We switched from the vitamins to the painkillers. We're not having fun anymore. We're having to have those difficult conversations around, if you do this, you only lose this much money. And I don't like doing that. I would way rather stay out on the front end of this thing. So for anyone that's feeling like, hey, we kind of missed the boat on milk, there's still good opportunities on the beef side. Or if you're like, hey, I wish I would have contracted more of my soybean meal or canola meal, there still are strategic things that you can do in these markets to position yourself and give yourself the advantage into this next year. So I think some people kind of treat it as like, well, I missed it, I'm going to throw my hands up and we'll just hope this comes back around again. But this is something that takes persistence. It's something that you have to kind of be into all the time.
And to just drive home that final key point, I would say, Curtis, from what you've been sharing as we wrap up our conversation today, is the opportunities are still there to apply some strategy as you look ahead into 2026 and to provide some protection for yourself in the marketplace in more ways than one. And Curtis, anything else that you'd like to add to our conversation today as we recap the November market update?
No, I think we're just keeping an eye on things here very closely. Like I said, for those that have been proactive, this next couple months is going to be a really nice time to kind of realize the fruits of all of the labor and time and strategy that goes into some of these plans. But for those that maybe feel like, hey, I missed it, don't beat yourself up. There's always stuff to do, and we're here to help kind of regardless of where you're coming from.
Well, thank you for that extension of your services, and for anyone interested in reaching out to you or your friends at HighGround for some insights on markets, there is a link in the show notes where you can download an updated report as well as get in touch with the team at HighGround. And so with that, Curtis, thanks for jumping on with us for the HighGround monthly market update.
Yep, thank you.
You just heard from Curtis Bosma with HighGround Dairy. For more information on HighGround Dairy, make sure to check the link in the show notes. I'm Peggy Coffeen, and until next time, keep on growing, keep on learning, and up-leveling your dairy.